A financial advisor is a professional who renders financial services to clients. According to the U.S. Financial Industry Regulatory Authority, terms such as financial advisor and financial planner are general terms or job titles used by investment professionals. FINRA describes the main groups of investment professionals who may use the term financial advisor to be brokers, investment advisors, accountants, lawyers, insurance agents, and financial planners. Additionally, it's key for financial advisors to understand how increasingly important investors are to the continued success of their firms. Role: financial advisors typically provide customers with financial products and services, depending on the licenses they hold and the training they have had. For example, an insurance agent may be qualified to sell both life insurance and variable annuities. A broker may also be a financial planner. A financial advisor may create financial plans for clients or sell financial products, or a combination of both. Compensation: a financial advisor is generally compensated through fees, commissions, or a combination of both. For example, a financial advisor may be compensated in one or more of the following ways: an hourly fee for advisory services, a flat fee, such as $500 per year, for an annual portfolio review or $2,000 for a financial plan, a commission on the securities bought or sold, such as $12 per trade, a commission based on the amount invested in a mutual fund or variable annuity, a markup when one buys house products, or a markdown when they are sold. A fee for assets under management, such as 1% annually of assets managed. Advisor versus advisor. Both spellings, advisor and advisor, are accepted and denotes someone who provides advice. According to one textbook, advisor or advisor are not interchangeable in the financial services industry, since the term advisor is generally used when referring to legislative acts and their requirements and advisor when referring to a practitioner. Since a financial advisor's practice is never described as an advisory practice, advisor is preferable when not referencing the law. Congress and the Securities Exchange Commission refer to investment advisors when discussing regulation of them in the Investment Advisors Act of 1940. Regulation. United States. In the United States, the Financial Industry Regulatory Authority regulates and oversees the activities of brokerage firms and their registered representatives. The Securities and Exchange Commission regulates investment advisors and their investment advisor representatives. Insurance companies, insurance agencies and insurance producers are regulated by state authorities. Investment advisors may be registered with state regulatory agencies, the Securities and Exchange Commission, or pursuant to certain exemptions, remain unregistered. Fiduciary standard. The anti-fraud provisions of the Investment Advisors Act of 1940 and most state laws impose a duty on IAs to act as fiduciaries in dealings with their clients. This means the advisor must hold the client's interest above its own in all matters. The Securities and Exchange Commission has said that an advisor has a duty to make reasonable investment recommendations independent of outside influences. Select broker-dealers based on their ability to provide the best execution of trades for accounts where the advisor has authority to select the broker-dealer. Make recommendations based on a reasonable inquiry into a client's investment objectives, financial situation, and other factors. Always place client interests ahead of its own. Since the financial crisis in 2008, there has been great debate regarding the fiduciary standard and to which advisors it should apply. In July 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act mandated increased consumer protection measures, including enhanced disclosures, and authorized the SEC to extend the fiduciary duty to include brokers rather than only advisors regulated by the 1940 Act. As of March 2013, the SEC has yet to extend the fiduciary duty to all brokers and advisors regardless of their designation. Opposition to the fiduciary standard maintains that the higher standard of fiduciary duty, versus the lower standard of suitability, would be too costly to implement and reduce choice for consumers. Registration. A registered investment advisor refers to an IA that is registered with the SEC or a state securities agency and typically provides investment advice to a retail investor or registered investment company such as a mutual fund or exchange-traded fund. Registration does not signify that the SEC has passed on the merit of a particular IA. Regulation is fragmented in that some registered investment advisors are regulated by the individual states, while others are regulated federally by the SEC. Canada. The financial advisor role in Canada is varied. Most financial advisors carry licenses to sell life insurance, securities, or mutual funds, or some combination of all three. The life insurance license is obtained through successful completion of the life license qualification program, except in Quebec, where licensing is completed through the Autorité des Marchés Financiers. There are three distinct securities licenses available. Completion of the Canadian securities course allows the sale of most types of securities, including stocks, bonds, and mutual funds. More advanced licensing is required for the sale of derivatives and commodities. Completion of a mutual funds course allows the advisor to sell mutual funds only, excluding certain types of very specialized funds and, importantly, exchange-traded funds. Although recently non-securities licensed financial advisors have gained access to ETFs through new mutual fund products. The third possible license is the exempt securities license. In many, but not all, cases, licensing requires the support of a dealer or insurer. It is also mandatory for advisors to carry errors and omissions insurance. The term financial advisor can refer to the entire spectrum of advisors. In general, the industry in Canada is segmented into three channels of advisors: MGA, MFDA and IIROC. However, there is little regulatory control exercised over use of the term, and, as such, many insurance brokers, insurance agents, securities brokers, financial planners and others identify themselves as financial advisors. Many financial advisors in Canada are also financial planners. While there are numerous financial planning designations, the most common is the Certified Financial Planner designation, although the Personal Financial Planner designation is also popular in Canada. There is no regulation, outside of Quebec, of the term financial planner. United Kingdom. There are three main bodies awarding qualifications for financial advisors in the UK. The main one is the Chartered Insurance Institute, which offers professional financial services qualifications all the way from beginner to degree levels. The IFS School of Finance offers alternative courses, qualifications in certain specialist areas such as mortgages and equity release. The Institute of Financial Planning offers the Certified Financial Planner. In the United Kingdom, investment advice is given either by a financial advisor or a stockbroker. Financial advisors need to pass a series of exams and receive a certificate in financial planning or the Certificate of Financial Advisors, and also authorized by the Financial Services Authority. A UK government Kango that must be satisfied that the advisor is a fit and proper person before they may practice. This is to be replaced in December 2012 with a new standard of qualification classed as diploma, and all existing advisors will have to attain the new qualifications to be able to continue to give advice in future. Typically a diploma or higher qualified advisor will have DIPFA or DIPPFs after their name. The title Chartered Financial Planner is the most widely accepted, gold standard qualification available for professional financial planners. Financial advisors in the United Kingdom. Financial advisors are either restricted or independent. An independent financial advisor is free to select a suitable solution for the client from all the products and providers in the market. An advisor that is not free to select from the entire market, for whatever reason, is restricted. An advisor may be restricted because they only advise on a specific area, for example pensions, or because they only advise on products from one company, such as a bank. Best advice is a concept that was never more than a heading in the FSA, PIA, NASDIM regulations, and which refers to the general obligation under contract law that a broker has to find the correct financial product to match a client need. A provider firm must not make a recommendation unless it has a suitable product to offer. If it offers no suitable products, then none should be recommended. A multi-tied firm must not make any recommendations unless it has access to a suitable product from the providers on their panel. In the UK, many believe impartial advice can be obtained only by consulting an independent financial advisor. Republic of Ireland, the QFA designation is awarded to those who pass the professional diploma in financial advice and agree to comply with the ongoing, continuous professional development requirements. It is the recognized benchmark designation for financial advisors working in retail financial services. The qualification and attaching CPD program meets the minimum competency requirements specified by the financial regulator for advising on and selling 5 categories of retail financial products: savings, investments and pensions, housing loans and associated insurances, consumer credit and associated insurances, shares, bonds and other investment instruments, life assurance protection policies. New Zealand, the National Certificate in Financial Services, Financial Advice, Level 5, is currently being introduced in New Zealand. All individuates and registered legal entities providing financial services must be registered as A. The directors, retail and sales staff are required to gain the national certificate. The New Zealand Qualifications Authority, in conjunction with industry groups via the ETITO, administers a qualifications framework for the qualification. Registrations and examinations are conducted by the ETITO. All financial advisors are required to register with the ETITO by March 31, 2011. The qualifications framework consists of a core set of competency sets, ABC, followed by 2 electives covering specialist areas such as insurance and residential property lending. Certain NZQA-approved qualifications such as an accountancy degree may exempt students from competency set A NZQA-approved training. The certificate is offered by the accredited organizations. South Korea. In South Korea, the Korea Financial Investment Association oversees the licensing of investment advisors. Australia, the Australian Securities and Investments Commission oversees the licensing of financial advisors. Additionally, financial advisors in Australia are subject to fiduciary obligations. For a comprehensive application of Australian fiduciary law to the Australian financial advice industry, see Fiduciary Relationships in a Commercial Context by J.